Before starting the video, click the subscribe button and turn on the notification bell. So in this lecture, we will discuss about what is bank reconciliation statement. What we are learned today: what is bank reconciliation, items to be included in the bank reconciliation statement on cash book or passbook side, and how to reconcile the items. So firstly, you have to know what is bank reconciliation and why do we prepare it. Bank reconciliation statement is prepared to reconcile the balance recorded by the company and the physical cash lying at the bank. So, as we know, there is an account prepared by the company in the company's account, and there is a physical balance lying at the bank. So, therefore, we have to reconcile the items which were left unrecorded either by the company or the bank, so that the balances which is recorded by the company and the physical cash balance should be equal. So what are unreconciled items or unrecorded items? Let us discuss about that. 3 things you must know before starting the bank reconciliation statement. If the company has added or deducted anything, the bank should do the same to equalize the balance. Or if the bank has added or deducted something, the company should do the same to equalize the balance. If either the company or the bank has added or deducted anything by mistake, so it should correct itself rather than the other should do the same mistake. Important things to note: that the cash lying at the bank is an asset for the company. So whenever the asset is written on the debit side, it is increased, or it is written in the positive side. So if it is written on the credit side, it is deducted, or it is in the negative form. Then the cash lying at the bank is a liability for the bank. So whenever the liability is written on the credit side, it is positive, and whenever it is written on debit side, it is negative or decreased. Items to be involved under bank reconciliation statement. Number 1, uncleared check. Number 2, unpresented check. Number 3, deposit in transit. Number 4, outstanding check. Number 5, interest, markup or profit. And the last one is standing order. Now let us discuss about the treatment in the bank reconciliation statement of all these items. Uncleared check: the check which is deposited by the company but not yet cleared by the bank. It is in the clearance process and it will take 2 days to get cleared. So the company would have added the check on the same time when it has deposited the check into the bank. So what will be the treatment? Let us see. The bank should add the same check into its accounts so that the balance would get equalized. Because the company has added it, so the bank should do the same to equalize the balance. Or the company should deduct it because the bank has not added it yet. So to get the balance equalized, there is another option that the company should deduct it so that it will get the equal balance, same as bank. Unpresented check: the check which is issued by the company but not yet presented at the bank. So when the company issued the check, it should have deducted the same from its books. So what should be the treatment? As the company has deducted the same check, the bank should do the same to equalize the balance. Or the other treatment can be that the company should add it back as the bank has not deducted it yet, so that the balance get equalized. So by these two modes, you can get the equalized balance. Deposit in transit. The check which is deposited but not yet reached to the bank and it is in transit. So the company would have added it in its books. So what should be the treatment of this check? The bank has to add the same to equalize the balance, or the company deduct it from its books as it is in transit and it has not reached to the bank yet. So the company should deduct it to get the balance equal to the bank. Outstanding check. It is a check which is presented at the bank but not yet paid by the bank. So it is little similar as unpresented check but not same as whole. So the company would deduct this from its books. So what should be the treatment? If the company has deducted the same check from its books, so the bank should do the same to equalize the balance, or the company should add it back to equalize the balance. Both can be conditions to get the equal balance. Markup, profit or interest, these are all same. So if the bank has paid the markup to the company, or in other words, we can say that the bank has credited the markup in company's account, so the company would add it in its books. And if the markup has been deducted by the bank, or in other words, debited by the bank from the company's balance, so the company should deduct it the same from its books. Standing orders. These are the instructions given by the company to receive or pay on company's behalf to the bank. So, if the bank has received any amount from someone on company's behalf, so company would add the same to its books to get the equal balance. Or if the bank has paid something on company's behalf, so company would deduct the same to get the equal balance. Check marked NSF or dishonored check. NSF means not sufficient fund. These checks are not added by the bank. So when the bank had received an advice that the company deposited any check, so company would have added these checks in its books. So what should be the treatment? That if the checks have not been added by the bank, so the company should deduct the same from its books. So let us take a look on a sample of bank reconciliation statement. Cash balance as per bank statement is 3 lakh. Then we are adding the deposit in transit as it is added by the company in its books. So we are adding this as 20,000. Then outstanding checks, as we have discussed before, that these checks would have been deducted by the company from its books, so the bank would do the same. It will deduct the outstanding checks. Now the bank has got the adjusted balance of 270,000. Then we have balance as per company's record, 260,000, and receivable collected by bank. So these are the standing orders which the bank had already added in its record, so the company has to do the same. 9,800 would be added. Then interest earned by the company, so the company has to add this in its books. So total 9,820 would be added. Then deduction, NSF check. NSF check means not sufficient fund check, 520. Then service charges 100, and then error on check 100 would be deducted. So the company would get the adjusted cash balance as the bank. So both have the equal balance as 270 and 270. So the lecture ends here. If you find any query in bank reconciliation statement, so you can put your question into the comment section and that will be answered in the next videos. Till then, good luck.